Good afternoon, ladies and gentlemen. Welcome to the 13th of May weekly market review. Today I have with me Gerald. How are you, Gerald?
Very well. Just came back from a long weekend break where we celebrated Mother's Day as well as Vesak Day.
Yes, I hope everyone had a good rest. I had a good catch up with my family and celebrated Mother's Day as well as managed to catch up on some sleep over the weekend. It was definitely a fantastic weekend because we heard from US and China that the trade talks went well and they are rolling back their tariffs to the 30% and the 10% level. So that gave market a significant boost. And then we also saw on Monday night that US Dow was up 1,000 points. So a lot of things are on the upside right now, as well as some of the results, the Singapore Bank results that came out last week. So a lot of things to cover today. I'll let Gerald bring you through what happened last week.
Yeah. The usual disclaimers that today's sharing is for information purposes only and should not be taken to be financial advice. We have an upcoming Ask SIAS on the 21st of May. If there's something that you're interested to join to ask Sunny, Ben, and myself questions, you can scan this QR code to register by the 20th of May. If you find the weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can scan this QR code or go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. So what we saw in the past week was mixed performance across various markets. The S&P 500 was down by 0.5%, pulling back slightly after the strong rally that we have seen in the 2 previous weeks, where we saw 9 consecutive days of up days for the S&P 500. The STI actually did well. It was up by 0.8% to 3,876 points, so not too far away from its all-time high of close to 4,000 points. The key macro development last week was really the Fed meeting. Investors were looking out for whether the Fed will cut interest rates, but the Fed decision was to keep the interest rate unchanged, given that there is still a big deal of uncertainty around the trade tariff and whether that will drive up inflation and slow economic growth. So that's something that the Fed has taken a wait and see approach. And with that, we have actually seen them maintaining the interest rates for the month of May. So with that, the US government bond yields actually bounced. The 10-year US government bond yield is now back to above 4.4%, given that the Fed has kept the interest rates unchanged, and also because the statements by the Fed Chairman Jerome Powell effectively highlighted that there is still a great deal of uncertainty, and it isn't so certain that the rate cut will come through in the next meeting. So that is what we see for the latest investor expectations. Investors are expecting that the Fed will keep the interest rate unchanged in the upcoming meeting in June, and likewise in July, before we see potentially rate cuts in September, October, and December this year. But even the upcoming rate cuts are not certain. Looking at the December Fed meeting as an example, there's equal likelihood between cutting interest rates then and keeping it unchanged. So I think that is where investors are still not certain around whether the Fed will cut interest rates aggressively. Okay, if I were to look at the performance of the Sing market, we saw that it had a slight gain in the past week. The gains were led by a number of the industrial names, such as Seatrium, SC Engineering, as well as SETS. And then if I were to look at the top losers, number of the REITs which actually went ex-dividend in the past week, including Mapletree Industrial Trust, Mapletree Logistics Trust, and Fraser's Logistics and Commercial Trust. What we also saw in the past week was the earnings reported by the Singapore banks. DBS, UOB, and OCBC all reported their first quarter earnings. And what we see here is that the banks have actually underperformed the STI year to date. DBS down by about 0.6%, OCBC 2.5%, and UOB 4.7% because of the uncertainty brought about by the trade tariff. Okay, so given the concerns around how that will impact the loan growth, the net interest margin, as well as the non-performing loans of the Singapore banks, they have actually come down compared to the STI, which still managed to see relative gains. So I start with the earnings of DBS here. DBS actually reported about flat profit before tax of about 1% up compared to first quarter 24. If I look at the profit before allowances, it was actually up by 6%. The company took some allowances, which I'll go through in more detail later. And as a result, the profit before tax was flat year on year. The group's net interest margin came down slightly to now 2.1% from 2.15% in 4Q24. As interest rates start to come down, the banks would generally see the net interest margins coming down as well. But what has helped to offset the decline in net interest margin was the continued growth in the fee income. So the fee income for DBS reached 1.5 billion. If I were to look at the growth, that is 18% growth compared to the previous year. So that is something that has helped to offset the weaker net interest margin. A big part of the growth is driven by the higher wealth management fees. We see here that that actually grew by 35% year on year to reach 724 million. I mentioned earlier that DBS took some allowances. This includes a general allowance of 205 million, which is more a prudent measure. They have not seen deterioration in the loan quality as yet, but this is meant to be preemptive in nature given the uncertainty due to the trade tariff. So with that, the allowance coverage ratio has risen to 137%, which gives DBS more buffer should there be a significant weakening in terms of its loan book. A lot of investors look at DBS for dividends, so that did not disappoint. The announced first quarter total dividend was 75 cents per share, which comprises 60 cents ordinary dividend and a 15 cents capital return dividend. So in total, 75 cents, which is above the 54 cents in the first quarter of 2024. So what I also noticed about DBS is that they have shared some of the challenges and opportunities that came through from the trade tariff. So while some of these challenges, such as trade disruption, interest rate uncertainty, has been flagged, they also highlighted some of the opportunities that may potentially come through, including how some of the shifting trade movements can lead to opportunities for them, and whether that can also create new opportunities in terms of continued wealth inflow for DBS. Overall, they have pretty much kept their 2025 outlook unchanged. They noted that the business momentum continued to be resilient in April. And with that, they expect that the group net interest income will be slightly above the 2024 levels on the expectations that there'll be 3 rate cuts this year. Okay, next I come to UOB. Here what we see is that the net profit was flat compared to the previous year at 1.49 billion, and the total income and the operating profit saw growth compared to the previous year. Okay, for UOB, what has been more resilient was actually the net interest margin. It stayed at 2%, which was unchanged compared to the previous year. And with that, UOB was able to grow its net interest income compared to the previous year. UOB also saw growth in its fee income, now at 896 million compared to 755 million in the previous year. For UOB, the growth in the fee income was driven by 2 key divisions. The wealth continued to grow, and likewise, the credit card fee income also continued to grow. Like DBS, UOB also took some general allowances on the loans that amounted to 133 million in the first quarter of the year. And once again, that is preemptive in nature given the uncertain macro environment. Okay, what is worth noting is that UOB has suspended its guidance for 2025 given the uncertainty on the macro situation, and they noted that they'll only resume the 2025 guidance when there's some stabilization in terms of the situation. Okay, lastly, I'll come to OCBC. OCBC saw a decline in its net interest income compared to the previous year. Total income was about flat compared to the previous year, and they also took more allowances compared to the previous year. So what we see here for OCBC is quite a steep decline in the net interest margin to now 2.04% in the first quarter versus 2.15% in fourth quarter last year and 2.27% in first quarter last year. Okay, OCBC saw also fairly strong growth in its non-interest income. Once again, that is driven by an increase in the fee income, which rose to 546 million compared to 479 million in the previous year. If I were to break down what is driving this increase in the fee income, the wealth management fee income grew from 228 million in the first quarter last year to 269 million in the first quarter this year. Okay, I mentioned earlier, OCBC also took some allowances. So 118 million of allowances for non-impaired assets. Once again, that is preemptive in nature and meant to cushion against any unexpected decline in terms of the loan book. Okay, for OCBC, they have maintained their 2025 financial targets. So net interest margin in the region of 2%, quite close to what it achieved in the first quarter of this year. And they have also maintained their guidance for a 60% total dividend payout ratio, as well as combined share buybacks as part of the 2.5 billion capital return over a 2-year period. So in summary, we have seen the net interest margins of the Singapore banks declining, with OCBC facing a more significant fall. The increase in the non-interest income has helped to cushion some of the earnings, and that is driven by an increase in the wealth management fee income, particularly for DBS and UOB. All three of the banks have taken more general provisions given the uncertain macro environment. DBS and OCBC have maintained their 2025 profit guidance, while UOB has suspended the guidance. So with that, we can see why DBS has actually done better compared to UOB and OCBC, given that the profit has actually been fairly resilient, and at the same time, they have maintained their guidance for 2025 profit. So at this point in time, the Singapore banks offer a dividend yield of above 6%. For DBS, we saw the announcement of a 75 cents dividend for the first quarter. If I analyze that, that's $3 for this year, which will work out to a dividend yield of close to 7%. UOB 6.6% dividend yield and OCBC 6.2% dividend yield. So to round up, we are now at the tail end of the earnings season in Singapore. We have got a number of REITs still continuing to report their results, and likewise SIA and Singpost earnings this week. DBS is going ex-dividend on Friday, 16th of May. And on the global macro side, I'll be looking out for the US CPI data. They'll be coming out tonight on the 13th of May. So with that, I'll hand over to Sunny for the technical analysis.
Okay, thanks, Gerald, for that insightful coverage on the bank's earnings. Indeed, still a lot of things happening in the capital markets coming up. We got a lot of REITs reporting their results this week. On the Singapore side, we also have the CPI data, which is coming up on the US side as well. So let me do a roundup on the STI index first. So as Gerald covered last week, we saw a 0.8% gain on the STI index going into the trade talks that we are seeing on the global front. But most of those gains last week on the STI were led by the three Singapore banks. So like DBS was up about more than 1%. OCBC was slightly lower, less than 0.5%. But OCBC, which underperformed among the three banks' results, did not manage to have a positive week last week. But you can see that on this Tuesday morning, it is trying to catch up 3.16% or $1.10. So just a heads up for you to look at the three Singapore banks, which Gerald shared is now giving a 6% dividend yield. For anyone that is looking to build a dividend portfolio, I think these are the three Singapore counters that you cannot miss. Okay, so on the STI index, you can see that we have reached above the 3,900 points level. So that is a very good sign, of course, led by the positive developments in the trade talks with US and China over the weekend. And hence, we saw this big jump this morning on the STI, up about 26 points or about 0.7%, now at 3,902 points. So where will be the next resistance level for the STI index? We are coming to a mini double top around the 3,950 points level. And once we breach above that, of course, the all-time high at 4,005 points will be in sight. So given that the tariffs has been rolled back or extended for 90 days, for Europe side, we are coming to the deadline in the first week of July, and on the Chinese side, we are looking at the first week of August. So those are dates to keep in mind. So tariffs has now been rolled back, and market is having a sort of a risk-on appetite again, and we are likely going to push up further. And I think for the STI index, before we reach the tariff deadline within a 1 or 2 months time, we should have a very positive chance of testing the all-time high at 4,005 points. Okay, indicator-wise, looking at the MACD indicator, we do have a little bit of boost this morning on the Tuesday morning. So that is still in line with the trajectory of the MACD line and the signal line. Both are still having an upwards kind of an angle. So it likely will trend upwards for the STI index as represented by the MACD indicator. Although we do see that there was some momentum that was being lost or slowed down last week, but that is due to the world going into the trade talks with US and China, and we are all holding our breath. Hence, there was some sort of a underperformance on the US indices, okay, prior to the weekend. So on the RSI indicator, you can see that the reading is now at 61. So it's like almost a picture perfect reading on the RSI indicator. Around the 60-point reading, that is showing us that the uptrend momentum do have a very healthy strength, and that momentum is likely going to continue until at least we reach the 70-point mark, which is the overbought level, and that could be somewhere closer to the 4,000 points level. So I think things are looking good on the STI index. Let's go and retest the 3,950 points level first, which sort of we touched this morning, but then we pull back to the 3,900 points level. Let's see if we can close around the 3,950 level this week, and that could give us a very good chance to retest the 4,000 level next week. Okay, next, let me move to the US indices. So Dow Jones Index, as you can see on my screen now, was up 1,160 points on Monday night. So this is a wonderful performance. This has pushed the Dow Jones closing number 42,410 above both the 200 and the 100 days moving average. So if we manage to stay above that, then yes, the sort of the bull case would be back on again. Okay, so that means that market will have more appetite for riskier asset like equities, and hence it could be beneficial to the US indices, stock indices, which could push it higher. Okay, so the next resistance level to watch out for would be this level over here. We have a push down during the late December period, okay, on the Dow Jones Index, and this level is now at 43,325 points. So 43,300 will be the next resistance level that we will look out for on the Dow Jones Index. And then once we have sort of challenged this level, we will be looking at the 44,400 levels or even the 45,000 all-time high level. Okay. Indicator-wise, I think the MACD is showing that the strength in the rebound that we have seen since the mid of April is still likely going to continue, and the strength of that momentum is likely going to carry on. And the RSI is showing very healthy momentum as well as the 62-point reading. So this rebound will likely continue up further, and hence testing the 43,300 points level in the next few weeks should not be a problem. And that will be the target that we will keep updating you through the weekly market review. Okay, next let's move to the broader index. You can see that the last candlestick, which is Monday night, the S&P index was up 3.2%, 184 points. We have clearly breach above the 200 days moving average, which is the sort of what some of my friends called the final boss, my technical friends call the final boss for the bull trend to sort of resume. So the S&P 500 has clearly breached and closed above that with the news of the US and China trade talk going well. And now at the 5,844 points level, it is resting on a very good zone where you can see during the December and January period where we are resting on this level, there's a lot of support coming in on the S&P 500 index. The next resistance level that we will likely see will be this level over here, which is on the 12th of November, the 6,000 handle or 6,012 points level. That is where the S&P 500 will be targeting now before we talk about the 6,150 points level, which is closer to the all-time high. Okay, so MACD indicator, the indication is still showing that the uptrend momentum, the rebound that we have been seeing in April, is likely to continue in the next few weeks, and hence the target will be the 6,000 handle that we are looking at for the S&P 500 towards the end of May. I would say that will be the level that we are tracking. And on the RSI at a 65-point reading, it's showing very strong momentum right now. And if it push above the 70-point mark, that is where that is the level that we will want to watch closely, because once it touched the 70-point level, as you can see in December over here, usually we will see some profit taking coming in for the index to consolidate before the next big move up or down. So S&P 500 end of May target will be the 6,000 level. Lastly, let's move to the tech-heavy NASDAQ Composite Index, which was the best performance on the Monday night restart day trading, up about 4.35% or 780 points. We have also cleared the big boss, the 200 days long-term moving average, the red line that you see here, and hence we are on a very good note that the index, NASDAQ Composite Index, will likely push higher. The next resistance level will be the high that you see on 8th of November over here at the 19,300 points level. And above that, there should be no kind of sort of key resistance level to watch out for before we retest the 20,000 or the 20,200 level, which was the all-time high that we saw in December last year. Okay. Momentum-wise indicator, MACD indicator is showing good, healthy momentum. We are likely going to see the MACD line pull further up away from the signal line. That means that the uptrend momentum is likely to continue at least above the 19,300 points level. So we still have at least 500-600 points to go before we see some resistance coming in for the NASDAQ Composite Index. On the RSI at 67, also very close to the 17-point overbought level. But I think if I'm going to zoom out a little bit, you can see that when the NASDAQ Composite usually goes on a very strong move, it's not a surprise to see the NASDAQ Composite actually test the, let me see here, the 80 points, 75 or 80 points level when the momentums get sort of a push upwards. Okay, so that being said, both the indicators MACD and RSI are showing that, hey, the rebound momentum that we are seeing right now will likely continue for the next few weeks. At least let's monitor it to the end of the month, and hence the target for the NASDAQ Composite will be the 19,000 handle. And the big event that will happen tonight, the CPI data, will likely also help to show that if the inflation is not growing as fast as what some of the markets might be predicting, then it could also give us another catalyst or another leg up on the US indices. Okay, so these are all the things that we would want to cover today. Anything else to add, Gerald?
Yes, so we have come through the end of the earnings season in Singapore. I shared the bank's earnings earlier. And I think what investors will look out for would be further developments around the trade tariffs. So far, we have seen some relief for, and at the same time, the inflation numbers coming through, because that will tell us whether the announcement of the tariffs in April has actually led to a spike in inflation.
Yes, so things are looking good and bright right now. So let's hope that things stay this way, and we'll continue to update you on the market developments on our weekly market review. So have a good trading week, and we'll see you again next week in the next weekly market review. Goodbye.
Thank you.